Today we are starting a new lecture on where we have 14 people. Okay, Jain, I will explain the third party. Can you hear me? Can you hear me? Okay, right. Before starting the lecture, one wants a small explanation. So, question is, what is third-party mortgages? Right? Third-party mortgages are mortgages where the property, the security which is not owned by the borrower. Right? Like I'm taking a loan. If my mother or brother gives a mortgage, their property as the security for the bank, then it is a third-party mortgage. As of now, when you consider a company, if the director gives his personal property as a security, that is also considered as third-party mortgages, right? So when the borrower, when the collateral is not owned by the borrower, then it is a third-party mortgage. Is it clear, Jani? Hope it is clear, right? Okay, right. Now we will go to today's lecture. Right, we'll go to today's lecture. We will be discussing most probably today and next week analysis and interpretation of financial statements, right? So we will discuss different techniques, then we will discuss some ratios. Financial analysis. What is financial analysis? It is assessing the past, present, and predicting the future. When we are doing a financial analysis, that is to find the strengths and weaknesses of a company's financial position, right? I'm doing a financial analysis for company. That means we want to find out what are the strengths of this company and what are the weaknesses, financial strengths and financial weaknesses. So we will be evaluating how the company operates during past few years and what is the how and what is the financial position today, and based on that we may do a projection in the future, right? So the tools are the financial statements. We will have different 3 types of financial statements. We'll look at it. Then what we do, we compare the financial ratios and trends from the past of the same company, and we may compare the financial details with the industry and sectors. Like, because if the company I am evaluating, if it is a tea manufacturer, then the entire tea manufacturing industry companies will have similar characteristics, right? Like gross profit margin, if I take just one example, gross profit margin of the same industry will be the same. There can't be drastical change among different companies on the same industry, right? Then we have 2 things: financial position and financial performance, right? Financial position is the book value, that is total assets minus liabilities. right? Assets minus liabilities. That means what? That is the amount of money the owners has invested in the business. These are financial liabilities, not the creditors and those stuff. These are long-term loans, right? Book value of a firm. Then you have revenue and expenses. You have the turnover minus expenses is what? Profit, net profit. We call that as the performance of a firm. We call asset minus liabilities as the financial position of a firm. Is it clear? Are you clear on what I'm telling now? Any questions about the financial position and performance? Then why we are doing evaluation, right? Right. Then we have the three types of financial statements. Balance sheet. Balance sheet is done for a specific day, right? We are doing a balance sheet for a specific day in order to look at the financial position. That means what are the investment in long-term assets? Any asset which has a useful life more than 12 months is called a fixed assets, right? This one, fixed assets, we did this. Then the current assets, current liabilities, any asset which can be converted to cash within 12 months period is called current asset. Can you see the board properly? Or is it too far? Right? You have fixed assets, current assets, any asset which can be converted to cash within 12 months, less than 12 months, right? This is greater than 12 months, right? Right? Then the current liabilities, any liability which needs to be settled within 12 months, right? Then you have finance by share capital, reserves, which is called net worth, right? Then term loans and leases, right? This is called equity capital, so this one, so that is this one. This is called debt capital. So this plus this is called total capital employed. These three together is called total assets. So this is your financial position. As at, right? Asset 31st 3 something. So that is financial position. Then you have your balance sheet, P&L, financial performance. It is for financial year period, right? So you have revenue or sales, direct cost, right? The cost items which changes with the number of units sold. Direct cost, gross profit, overheads, profit before interest and depreciation, interest, depreciation, operating profit, other income, net profit. So this is your how you have performed financially during a period. It can be from 1st 4/2018 to 31st 3/2019. We write that as financial year 2018 to ending 19. Right? So we are starting from 2018 ending 19. So we write like that. We write this as this 2019. So this is the financial position and this is the financial performance. Then we have cash flow statement, right? Cash flow. That is also for period. Okay. So we have cash coming in, cash inflow and cash outflow of the business. Right? So we will be evaluating, this comes from operating activities, operational activities, investment, and financing activities, right? So basically we are evaluating what are the cash into the business and cash into the business and out of the business. Then we take the net cash position, and that is the cash, liquid cash we have for the period. This is also for financial year, this one. Okay. So this is for a per day, for a specific day. This is a picture, snapshot of financial. This is during the year how we have operated. This is during that period how the money has come into the business and gone out of the business. Right? No. Is it clear? 3 types of statements we have. So basically financial evaluation revolves around these 3 statements. Right? This statement, and when you are doing credit, basically what you do, you try to evaluate these financial positions. Right? So we go to this one. Shows the financial position of the firm, asset, liabilities on a particular day, where present the results of operations, revenue, expenses, profit, loss, all the accounting period. Right? Then cash flow statement, statement of cash flow provides information about the cash inflows and cash outflows from operating, financing, and investing activities during a specific period. Right? Then financial statement analysis. What do you mean by financial statement activity? That is tearing apart the financial statements and looking at the relationships. Right? When we are doing financial statement analysis, we will be taking different parts from different statements, or we will take it out differently from the same statement. Like we may discuss about the current assets and liabilities, liquidity position of the company. Then we will discuss, like you can see this. This is the revenue and the relationship between revenue and these particular items. Right? Then going down somewhere here, we may discuss how the business has funded. Right? So those things we will discuss. So tearing apart these statements and looking at relationship is called financial statement analysis. Who will be doing financial statement analysis? Is twofold. It is internal users and external users. Who are the internal users? The management. They're the internal users. Why do we need internal users financial statement? In order to evaluate their performance, in order to plan the future, budgeting, cost reductions, all those things you base on the finance. You go to the next slide. What do internal users do? Planning, evaluating, and controlling company operations. Right? So we use the financial statement to predict our future. We evaluate the past, evaluate the present. Based on the past and the present, we predict the future. So internal users, in order to do budgeting, in order to do cost control, in order even to budget for headcount, you need financial position. See, this is an interlinked chain. You need to know the market. Then, based on that, we do all projections. The conversion of market into rupee and cents is the financial position. I have a market of where I can sell 10,000 shares per month. When I look at the financial statement, it says only 2,000 I have sold. Then there has to be something wrong. Right? It may be quality, it may be marketing, it may be production capacity, anything. So all these things are linked. Right? So internal users use financial statement for the budget analysis. Then the external users. Who are the external users? Investors. Right? All investors go through our financial statements before deciding the investment. So they look at our past performance and they predict the future for the banks or anywhere. Then only they will decide whether they are invested, because they will put money, earn some return and take out money. In order to do that, this company has to be stable, solid company. Right? Investors, creditors, they will look at different ratios before giving credit to the company. Regulatory agencies like central bank will watch the banks and the finance companies, those things. And stock market analysts. We are giving stock market brokers, they give you a detailed analysis of business. Based on that, investors invest. Right? What do external users do? Assess the past performance, current financial position, and make predictions about financial profitability in the future. Based on that only, even the rating agencies use financial data in order to rate. That's why they downgraded the entire banking system of this country. They predict a tougher time in the future. Financial statement analysis information is available from published annual reports. In annual reports, we have the financial statements, then you have notes, letter to the stockholders, shareholders, auditors report. This is an independent report about our financial position. What do you mean by qualifying auditor statement, is it a good thing or bad thing? Give me answer. Auditor has qualified the bank statement, financial position. Is it good or bad? You can on the mic and tell me, or you can text me. You can use the chat. When someone says auditor has qualified the financial statement, is it a good thing or bad thing? Any more answers? So you can tell anything because no one sees your face. Because sometimes we feel shy to publicly speak out. 1, 2, 3. I have 21 people. Only 3 people answered. I told you one thing earlier. You can ask a question, 4 people answer. Ask a question and be fool for few seconds. Don't ask a question and be a fool for lifetime. Right? So don't worry to ask because no one knows everything. Even I don't know many things. What I tell you is what I know. Right. I have 1, 2, 3, 4, 5, 6 answers. 5 in one line, 7 answers. 5 in one line and 2 in other line. 3 in other line. 8 to 5 to 3. Right. 5 people told me it is good. 3 people told me it is bad. Yes, it is bad. Qualifying means it is not the word English meaning of qualifying. Like we say you are qualified. Right? That is good. When the auditor says, I qualify this statement, that is bad. Subject to. There means subject to. I have not seen this information. Though I am signing, I am qualifying it saying that I have not seen this. So whenever we say auditor has qualified the financial report, that means it is bad. Right? So normally qualified means good, but when it comes to financial statements or audit reports, annual reports, if the auditor says I qualify this statement, then it is bad, right? So, okay. Then management discussion. The top management will tell their thinking and future strategies, the bank-wise strategies, sector like risk strategies, credit strategies, those things. They will discuss. This is a discussion point, not purely they are not giving out the strategies, but they will discuss how we operate. So we can take all those things as the published reports. Then other sources, Financial Times, FT, is a key source in getting information. Then periodics like LMD. Then financial information organizations. What are these companies? Moody's, Standard and Poor, Dunstan and Bradstreet. That is we call D&B. What are they doing? Anyone has idea?
They are rating agencies?
Yes, they are rating agencies. Like these companies, they rate companies internationally. We can write to them and ask for the rates. They will give. They will compare They will give the financial positions. They will check the legal systems around the world and see whether they have any legal cases, any recorded non-payments, and all those things. Like they are rating agencies, they give ratings plus financial evaluation as well. So we can take information from them. Right? Very good. So Moody's, the Standard and Poor, DNB, whenever we talk about export products, we take DNB report. They are specialized in giving exporter reports across the world. Right. Then we come to the methods of financial statement analysis. We have horizontal analysis, vertical analysis, common size financial statements, trend percentage, and ratio analysis. So we will discuss each of it. Horizontal analysis. Horizontal analysis is, take this, we take this one. So this is for one specific period, right? We are comparing turnover of this year with the turnover of other year. Horizontally, we are comparing two items in financial statement. Comparable financial statements, like I have ABC company financial statements. I will be evaluating horizontally two periods. Turnover, how the turnover has changed, whether how much rupees it has changed, what is the percentage change. We have two things: rupee change, there is absolute value change, and percentage change. Using comparative financial statements to calculate rupee or percentage change in a financial statement item from one period to the next period. That means, see, this one is for specific period, right? This is for the financial year 18-19. So we will compare revenue of 17-18 and 18-19. Gross profit of 17-18 and 18-19. Direct cost of that. Like that, we can compare horizontally. Right? Then we go to second one, vertically. For single financial statement, each item is expressed as a percentage of a significant total. For single financial statement, each item is represented as a percentage of a major item. Like in P&L, each of these direct costs as a percentage of turnover, gross profit as a percentage of turnover, overhead as a percentage of turnover, right? Like that we compare vertically. It's not horizontal, now it is vertical. Right? For single financial statement, each item is expressed as a percentage of a significant total. All income statement items are expressed as a right? Yeah, we were doing this horizontal, vertical. So is expressed as a percentage of a significant total in all income statements, right? Then we'll go to common size statement, right? Financial statements that shows only percentages. This is a common size statement. See this statement. You have the second handout. Go to second handout. Right? This one, see, 2010 sales is 100%. This one 83, gross profit 16. How we have done is actual absolute value is 3.9, 3,900 million, right? Thousands. So 3250 divided by this one. Then you get the percentage. Each item is represented as a percentage of the major total. So this is a percentage. Right? So financial statement, we are not taking this one. We are taking only these percentages as the statement. Come to balance sheet. It is again percentages. We don't take the absolute one. Why do we create this kind of statements? Only percentage. Everything shows as a percentage, not value. Any idea why we do that kind of things? This is in order to get rid of the size of the business. See, you have a soap manufacturer. Unilever is the largest soap manufacturer in the country, right? They are doing a $1 billion business. So we say the turnover is 3 billion, right? Then we have Swadeshi Industries. I don't know the figures. I'm just giving ballpark figures, right? Few billions, and when it comes to Swadeshi, it is some 100 millions, right? So you can't compare Unilever and Swadeshi because turnover levels are huge. But when it comes to gross profit, Unilever may be earning 500 million, whereas Swadeshi is earning 300 million. Now again, 500 million is bigger than 300 million. Does it mean that Unilever is good or smaller value? Swadeshi is good. See, Unilever has a 1.5 billion turnover. Swadeshi has 900 million turnover. Gross profit, this one 500, this one 300. Which one is good? This is big, so this is good. You can't say that. See, you take the percentage, 500 divided by 1,500, which is 0.33, 33%. Again, sorry. We said 400 divided by 900, which is 44%. Right? So, though this is small, gross profit wise, this is good. You can't compare bigger firm with a smaller firm. This firm may be efficient, right? In order to get rid of the size of a business, we use common size statements, right? These common size statements are used to get rid of the size of a business. Financial statement that shows only percentage terms and not the absolute rupee amount. So we will be showing only percentages, common size. Then we go to trend percentages. I told you horizontal analysis, we compare two periods of the same comparative financial statements. We compare two periods. In a present trend analysis, what we do, we compare year on year how the turnover has changed over 5, 6, 7, 8, 10 years. We compare how the company's direct cost has changed or has moved over 10 years. So it is a trend analysis, percentage trend analysis. Sorry. Right? Shows change over time in given financial statement items. Can help evaluate financial information of several years. So it is a horizontal analysis, but we compare the same item for a longer period of time, maybe 7 years, 8 years, 10 years, whatever. But when we talk about horizontal analysis, it is only comparing two financial years. Then ratio analysis. Expression of logical relationship between items in a financial statement of a single period. Right? What is the relationship between turnover and gross profit? What is the relationship between current assets and current liability? What is the relationship between total assets and the equity? Like that. Percentage relationship between revenue and net income. So expression of logical relationships between items in a financial statement of single period. This is for single period. So we will when you are doing a financial statement analysis, we are doing a combination of these things: vertical, horizontal, trend, and ratio analysis. Right. We can go to some examples. Before that, you have any questions about horizontal, vertical, percentage, and trend and the ratio analysis? Any questions? Is it clear? Can I move forward? But no, all are sleeping over. Okay. Right. Okay, this is a financial statement, balance sheet figures given. This one, rupee change, right? You have to get it done while they were doing it. When they were converting my presentation into their PDF mode, they have deleted this or something, can't see. So you have to write it down. Change rupee amount. Rupee change is current year figure minus base year figure. Rupees current year figure minus base year. The result will come in rupees. Then change in rupee again, since we are measuring the amount of change between two. This is the example given. Then the percentage is change divided by base. Rupee change divided by the base year figure. We say we have a example of 5 million rupees here and 3 million here. Rupee change is 5 million minus 3 million, which is 2 million. Then this one is 2 million divided by 3 million into 100. 2 million rupee change divided by base year into 100. Right? Please write it down. Let's come to this one. Right? So we are doing a horizontal evaluation. What is the change of cash position? 2018 is the base year. Current year is 2019. So rupee change is 12,000 minus 23,500. It is this. Percentage change is 15,500 divided by 23,500. Since it is negative, which is a deficit, this is also deficit, right? Right? Rupee change divided by base year change into 100. So work out these balance figures. At least first 3 cases you work out and tell me you are finished. Work out the first 3 numbers. What is the rupee change and what is the percentage change? And say you are finished. Right? You do it and let me know you are finished. When at least 10 people tell me you are finished, I'll start the lecture again. So in this case, 60,000 minus 40. So it is 20,000 here. Here, 20 divided by 40. Like that, you finish this 3. Once you finish, say you're done. So I can start. I need 10 people to say done. One, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Right. Right. So we go to the other one. This is the total figures you have. There's no change, so it is 0, 35, 120, 40%. Same procedure to the stockholder. That's the liability part. Then we go to the P&L. How the year on year, how turnover has changed. From here to here, 40,000 growth positive, which is 8.3. 40 divided by 480,000. How can you interpret this? Net sales has grown. How do you interpret? Net sales has grown by 8.3. Whereas net income has come down by 21.9. Tell me why. One reason for that. One reason for that. Turnover has grown by 8.3. Right? But net profit has come increase in operating cost. Any other thing? Anyone else? Increase in tax, decrease in margins. I want you have to look at the figures and let me say sales reduction, decrease in gross margin. I say this one. This has increased by 8.3. Cost of goods sold has increased by 14.3. So, though the turnover has increased, margin has come down. Right? Cost has gone up. So, gross margin has come down to minus. Then operating expenses has increased by 2.1%. Net operating income has increases, decreases, like that. Right? So you are correct. Sales reduction, you can't say. Because sales has grown by 8.3. 8.3% sales growth. But cost has grown higher than the sales. That's the issue we have. Therefore, the margin has come down. Okay. As a credit person, your job is to evaluate finance. Like there is a difference between evaluation accountant does and a bank credit person does. Accounting person will tell, okay, turnover has changed by 8%, net profit has come down by this much, all figures, he will give figures, right, ratio. But bank needs to find out the reason behind all this increase or decrease. So whenever you are evaluating, it has to be the reason behind, not just turnover has increased, gross profit has decreased, that anyone can see. But you have to say why it has happened. What is the reason turnover has increased? What is the reason gross profit has come down? Right? If you say gross profit has come down because cost of goods sold has increased, then you have to say why it has increased. Right? That is credit evaluation. The increase in both cost of goods sold and operating expenses. The increase cost more than the offset the increase to sales, yielding on the overall decrease in net income. Then vertical example. Right? Cash. So here, this year, total is 483,000. You have taken as a percentage. Each item is taken as a percentage from total. 17%. 83 divided by 483, 82,000 divided by 483,000 is 17. 30,000 divided by 387,000 is 8. So this is called vertical evaluation. If you start comparing these two, it is horizontal evaluation. Right? That means in year 2018, out of the total assets, 8% was cash. 2019, out of the total assets, 17% is cash. That means cash position has increased compared to the total assets, which is a good sign. This is what I told. Then we go to the liability side. Then we come to the percentage example. See, these are 1, 2, 3, 4, 5 years. We are taking the figures for this. Work out the trend of revenue. How do you work out? First, you find the difference between this. Then divided by the base year figure. It has to be divided by base year figure. Try to work out the first year. How it has changed. You can see it. Work out. Don't look at the other ones. You just work out this. Work out the percentages of this and let me know once you finish. More than 10 people has to say finish. Yes, just do the one part, then you can do it later on. Do the revenue. 6 people done. Okay. So this is the calculation. 100. So it is easy. That means this is 100. This has grown by 9% from here. This has grown by 16% from here. This has grown by 23%. This is the traditional way of doing. You find out the difference divided by base here. I'll tell you an easy way. You just divide this one by this. You will get 1.09. That is 109%. This, if you divide this 1.23, then it is 123%. Like that, you just divide. If you want, you can say the turnover has grown by 9% from here. From here to here, it is 23%. Here to here, what is? Here to here, what is? So you just divide by 2, also you get the figure, but in a different mode. Try that and see. The same answer is coming. First one, when you divide, it is 1.09. You have with the 2 decimals. So multiply it by 100. So it is 109. 1.16 into 100, 160. Did anyone do that? That is the easier way than doing 3 sums together. Subtraction and division. So straight away you divide. That is a shortcut. So any percentage you can do like that. You don't need to find the change and divide by the base. You can just divide by the base figure. So you get the change 1 point this. So if you want just the 9% or something, you take out the first digit. Right. Then we go to 10%. So that's the trend lines we have. After you do the calculation, you can plot it. See? Sales 1.9, 1.6, 16%, 23%, like that. So it is, this is a trend line. Here we come to ratios. Ratios can be expressed in 3 ways like this. Ratio as a percentage or rupee terms. Right? Ratio is 1:2. Per rupee of current assets, we have 2 rupees of current, per rupee of current liabilities, we have 2 rupees of current assets. Then you can say profit margin is 2%. Or you can say in rupees, earning per share is 2.25 rupees. So you can write like this, or as a percentage, or some ratios can be written in rupee terms as well. Using ratios and percentages without considering the underlying cost, may you cut it down. So strike this one off, leads to incorrect conclusion. That means without knowing the proper underlying reasons, if you use a ratio, you will come into wrong conclusions. Right. There are few types of ratios. First one is liquidity ratio, equity ratio, so long-term solvency ratio, profitability ratio, so test, market test. These are the 4 types of ratios, right? Liquidity ratio, equity or solvency ratios, profitability ratios or profitability trend, and market test ratios. Liquidity ratios indicate short-term debt repayment capacity, right? Liquidity ratio, how liquid is the company? Who are interested about how liquid is the company? Tell me who are interested on a company, who are interested about how liquid the company is. That means current assets and current liabilities. Who are interested about that? Traders? Anyone else? Investors?
Creditors.
What is it?
Creditors.
Yeah, creditors. Shareholders will be interested about everything, but mainly who are interested on liquidity. Short-term fund providers, traders, then banks, all those people. Whoever is funding the current assets, right? These people are interested about finding the liquidity position. Okay. Then equity, long-term solvency, debt equity. Who are interested? Show the relationship between debt and equity. Shareholders, long-term lenders, they are worried about this part, how the business has been funded, right? Long-term solvency is how the business had been funded. Show the relationship between debt and equity financing in a company. Profitability, that is the P&L relationships. Market test, that is earning per share. How much we earn. Those kind of things. These we calculate only for listed companies, not for all the companies. But for these 3 items, we calculate for any company. Right. There are 10 ratios you should know. Current ratio, acid test or quick ratio, account receivable turnover, and the account receivable period. Similarly, you can work out inventory residence period and inventory turnover period. Creditor payment period and creditor payment period and creditor settlement number of amounts, days, right? Inventory turnover. Then you can work out the equity ratio, debt equity ratio. Then profit margins, return on equity, and earnings per share, price earning ratio. Right? These are the 10 ratios we are going to work out. Right? So these are the figures we have. This is the cash. Before going into that, whenever you are doing a ratio, if the figures are taken only from the balance sheet or only from the P&L, you can take the figures as it is. Right? We say current assets are 15 million. Right? Current liabilities 11 million. Gross profit, we say around 20 million. Sorry, this one, cost of sales is 20 million. If you are working out a ratio using only this, you can use just 15 and 11. Your revenue is 50 million. Right? If you are using calculating a ratio using only these two figures, you can take the figures as it is. But if you are using figures from here and figures from here to calculate a relationship or ratio, then you need to take these figures as an average current assets, average current liabilities, average inventory position, average debtor position. But this figure you can take as it is. Can anyone tell me why it is? Why? We have to take average figures whenever we are taking a figure from balance sheet. We can take the figure as it is from P&L. Why is that? Any idea? Any idea? Because balance sheet is for a day. Right. Balance sheet carries figures in a particular day. Very good. Arush. Right? This is for a day. This is for a period. If we take just the same figure, there is a disparity about the period. Like this is for a day and this is for a period. In order to avoid this timing difference, we take the average figures. When you take the average figures, it consider period again. Average figures here and the figure as it is from here. This is for a year. We take the opening balance and the closing balance divided by 2 here. Right? In order to take the average, we should have 2 balance sheet dates. Take the 2 balance sheet date figures and divided by 2 will be the average figure here. Right? That is to get rid of the timing difference between the 2 financial statements. Is it clear? Whenever you are doing ratio analysis using the 2 different statements, P&L and balance sheet, you have to take average figures for the balance sheet figures, and for the P&L you can take the figure as it is. Right? Okay. Right? So you have cash, account receivable, inventory, beginning, end, that is to get the average. So first one is the working capital. It is not a ratio, but it gives a figure 63,000, 65,000 minus current working capital is current assets minus current liabilities. What is the cushion we have? While this is not a ratio, it does give the indication of company's liquidity. 65 is the current assets, current liabilities 43. The difference between this is the liquidity. That means after finance, like you have a 42 million, so 42,000 current liabilities to be serviced within 1 year. You have 65,000 worth current assets, which can be converted within 12 months to cash. So after settling the current liabilities, you have another 23,000 excess cash. That is the meaning of this. So this indicates the liquidity position of the business, net working capital. Then we come to current assets and current liabilities, which is the current ratio. This is the ratio we take to check the liquidity of the business. Current ratio, right? Current assets divided by current liability. Per rupee of current assets, there are 1.55 rupees of current assets. Per rupee of current liabilities, there are 1.55 of current. So if you divide this just by 65,000 divided by 42,000, which is 1.55, right? That is, you have a cover of 55% more than the, so normally we say just 1.55. It indicates per rupee of current liabilities, there is a cover of 1.55 times current assets. This is current ratio. Right? The box says, measure the ability of the company to pay current debt as they become due, right? So this ratio coming down means what? See, though you have a value, that when you want to dispose, the ability to get cash will come down. I say I have stocks of 100 million, but if I want to sell it, it will earn only 800 million for me, right? There is a difference between the value and the actual market realizability, right? So always you should have a additional cover for the liability. Equal 1-to-1 cover is very dangerous. So whenever the current liability holders look at a business, they look at, okay, what is the cover I have? The company has current liabilities of 100 million. If the current assets are only 105, if something goes wrong, current liabilities will not be settled. If I have 2 times 200 million against 100 million current liabilities, that means even if the current asset value comes down, I will be paid, right? So current ratio indicates the cover the current liabilities has over and above the value. Then you have the quick test or quick assets, right? Asset test, quick ratio, whatever. Current assets equal right? Current ratio equals current assets divided by current liabilities. What is the cover you have from current liabilities? Right? Quick ratio is current assets minus this one, inventory, fixed assets. Then nearest to the fixed asset is inventory, right? This is the most difficult item to convert to cash. Inventory is the most difficult item in order to convert to cash. So current assets minus inventory divided by current liabilities. So if you have something like 1, 2.9, something like this, this is a good ratio. If you have 1, this is a good ratio. You don't need to have more than 1. This has to be over at least 1.5, 1.2, 1.5 times, right? In order to be safer, 20% margin. Here, 1 to 1 also okay. So current assets minus inventory divided by current liabilities is the figure. But if you are given debtors, marketable shares, and notes, commercial notes, commercial paper, receivable, cash, you just take these items and divide it by current liabilities, right? Sometimes in the institute we are seeing they are giving these items, right? That's these items. We have the cash, marketable securities, account receivables, net. What does net means? Hardcore accounts, you can take it out. Bad provisioning, you can take out. And current note receivables. Quick assets are these items. If they have given these figures, you take only these figures. If they have not given the detailed breakup of like this, you take current assets minus inventory divided by current liabilities for quick asset. Quick ratio or acid test. Right? Quick ratio or acid test. So that is the more liquid ratio. Current ratio is the liquidity testing ratio, but this ratio gives additional value, more liquidity, right? True liquidity, because inventory is the hardest to convert to cash. Okay. Any questions so far? Is it clear? Can I proceed? Is it clear? Current ratio? Okay. Right. Then we go to this example, quick assets. Right. From these figures, try to work out the quick ratio. So we have cash, we have account receivable, right? 30 plus 20. Inventory, you have 12. So 30, 20, 12. Total current asset. If you want to get the current ratio, it is 65 divided by 42. If you want to get the quick ratio, it is 30 plus 20, which is 50 divided by 42. 65 by 42, 1 is to 55. Quick ratio, 30 plus 20, 50 divided by 42, 1.19 to 1. Right? See, this is lower than the current ratio always. Right. Account receivable turnover. Okay. You have current assets, which is inventory, debtors. Someone's mic is on. P&L, you have turnover, direct cost, or cost of goods sold, gross profit, right? Gross profit, overheads, PBID. Now we want to see account receivable turnover. That means how many times per year we collect our debtors. How many times per year we collect our debtors. So it is equal to account receivable turnover equals to credit sales divided by average debtors. Why? Balance sheet. This comes from this one, P&L. This comes from balance sheet. This is asset. This is for financial year 2017-18 or whatever. Right? So these two are coming from two different. You can see the board, right? You can see the board now. Right? So debtors comes from the balance sheet. So we have to take average. This one comes from P&L. So you take the figures as it is. Right? Whenever you are talking about account receivable or debtor turnover, right? Then we talk about credit sales. Sales turnover is two types: cash, credit. This is called terms of trade. Right? So credit sales divided by average debtors. This gives per annum how many times you collect your debtors. Debtor turnover. Then we have something other thing called debtor collection period, which is average debtors divided by credit sales into 365. On average, how many days you take to collect your debtors? This ratio tells you per annum how many times you collect your debtors. This one says how many, on average, how many days your debtors will be there. How many days you take to collect your debtors. Look at this first. Your sales was 494. This one sales was 494, right? Then inventory, account receivables were beginning of the year it is 17,000, then it is 20,000. So it is, we have assumed that entire sales is credit sales. 494 divided by 17 plus 20 divided by 2, which is 26.7. That means annually we collect our debtors 26 times, right? Then we go on to say this one. The same thing, you make it upside down and increase by, multiply by 365. That means on average, you take minimum of 13.7 days to collect your debtors. දවස් 13කට සැරයක් තමයි වට payment සම්බෙන්නේ. Right? Is it clear? Is it clear? I want to know, because all the other things revolve around this. Is it clear to you? Right. I got two answers, 2 years. That's all. I have 20 people in the class now. 3. Anyone to whom it is not clear and you want me to clear it again, tell it again? So I assume everyone, can you explain? Okay. 1, 2, 3, 4 again. Right. This one, right? You have a balance sheet. where you have inventory and debtors. This is your account receivables. You have your sales, which is cash and credit, right? Ratio, the type of ratios, account receivable turnover period, right? What do you mean by that? How many times, how many days on average you take to collect your debtors? දවස් කීයකට සැරයක්ද ඔයාලට සල්ලි හම්බෙන්නේ? ඔයා මාකට් එකෙන් සල්ලි කලෙක්ට් කරන්න සාමාන්‍යයෙන් දවස් කීයක් යනවද? මේ හතරවෙනි එකේ කියන්නේ දවස් ගාන. Number 4 talk to you about the number of days. Number 3, ratio 3, which is the same thing, it says per annum how many times you collect your debtors. අපි දන්නවනේ අවුරුද්දකට කී සැරයක් debtors ලව collect කරනවද කියලා. ඒක 365 ඒකෙන් බෙදන්න තමයි තියෙන්නේ. හරි? First one is average account receivable turnover, which is credit sales divided by average debtors. How many times per year you collect your debtors, right? Account collection period, debtor collection period, account receivable turnover, account receivable period, account receivable collection period. Maybe මේකයි පටලවා ගන්න එපා එකම දේ. account receivable කිව්වත් එකයි, debtor කිව්වත් එකයි. debtor turnover, right? debtor collection period. So how many days you take to collect your debtors on average? That is equal to average debtors divided by credit sales into 365. That means may ratio 1 upon ART into 365. මේ කියන්නේ මේකම තමයි මේක උඩයට මාරු වෙලා තියෙන්නේ. Right? So if it says account receivable turnover, that means per annum how many times you collect your debtors. Account collection period, debtor collection period means how many days you take to collect your debtors. How many days on average you need to collect your debtors. Account receivable and debtor all the same, right? There is no difference. Account receivable turnover, debtor turnover. Average, credit sales divided by average debtor. Turnover period. That means this shows you how many times per annum debtors are collected. This gives you number of days before collecting your debtors. Hence, බඩු දීලා දවස් කොච්චරකින්ද සල්ලි හම්බෙන්නේ කියලා. After selling, after how many days you get your collection. Right? The same thing upside down inversion of that into 365. Is it clear now? Okay. Patum? Is it clear? Okay. Right. Then number 4. So similar thing. Now we talk about inventory turnover and inventory turnover period, right? Earlier we spoke about debtor turnover and debtor turnover period. How many times on average debtors are collected? How many collected? That's the number of times. Then on average, how many days you take to collect your debtors? Similarly, for inventory. Inventory turnover. How many times per annum inventory is converted to sales? How many times per annum inventory is converted to sales? Second one is how, on average, how many days you hold inventory? How many days you take the inventory to convert to sales, right? So this one is not sales. We are using cost of goods sold. Inventory relates to cost of goods. So cost of goods sold or direct cost divided by average inventory. Some people take purchases. If you have purchases, you can take, the difference is very slight because major portion of cost of goods is inventory, raw material, right? Cost of goods sold divided by average inventory. These figures may have come from top, 1,400 into divided by 10 plus 12 divided by 2. That means on average during a year, inventory is converted to sales 12.7 times, right? If you talk about inventory turnover period, it is average inventory divided by cost of goods sold into 365. It's not there, right? Average inventory. First, what we did first was debtor turnover, which is credit sales sales divided by average debtors. How many times per annum debtors are collected? Second one is debtor turnover period, the collection period over period. When you talk about period, it is number of days. Average debtors divided by credit sales into 365. Right? Then we spoke about inventory turnover. This is cost of goods sold divided by average inventory. Then you come to inventory turnover period. Average inventory divided by cost of goods sold into 365. Similarly, you can work out creditor payment co-creator turnover, which is equal to cost of goods sold divided by average If you have purchases, you use purchases here into 365, this one. Creditor payment period equals average creditors divided by cost of goods sold into 365. Right? These ratios, three types of ratios, are called efficiency ratios as well. How efficiently you have worked out your working capital, how efficiently you have managed your short-term assets and liabilities, right? So that is called liquidity ratios, or these three specifically called efficiency ratios, right? Is it clear? Up to now, I have done 4, 5, 6. Like this is not there, but I am doing it normally. Is it okay? Is the ratios up to now what I did clear to you? These ratios are very important. If you are a credit person, you need ratios, right? Any valuation can't be done without proper ratios. Okay, if it is clear and no questions, do you have any questions to answer? You want anything from me? Right, if no questions, everything, if these things are clear, I'll stop the class for today. And next week, I'll finish the balance part of the ratios. And if time permits, next week, I'm starting working capital. Right? You need this. Basically, working capital revolves around this one. Okay. Thank you very much.